February 3rd, 2026, 2:47 p.m. EST. The response will be proportionate but will not be announced. Statement attributed to the Vice President of the Central Military Commission of the People's Republic of China. Recorded in classified internal communication 72 hours before the start of the coordinated actions. Operation name: Red Dragon. The People's Republic of China does not operate through impulsive responses. Its state bodies operate in overlapping layers of strategic planning, where each public move is preceded by months of silent preparation. When the United States government announced, on January 28, 2026, the imposition of punitive 35% tariffs on nations that maintained active trade agreements with Iran, including historic allies of Beijing, such as Pakistan, Russia, and the United Arab Emirates, the Chinese response was already in the final stage of operational validation. The primary target was not a person. It was a system, specifically, the industrial financial complex that supports the hegemony of the US dollar in global energy trade. China has identified this system as an objective of high strategic value since 2018, when US secondary sanctions began to be applied extraterritorially against Chinese financial institutions. What Washington interpreted as commercial retaliation was, in fact, the activation of an operational architecture built over 8 years. The scale of the operation was comparable to the coordination needed during the Cuban Missile Crisis, not in terms of direct nuclear confrontation, but in the seamless integration of diplomacy, economics, logistics, and information warfare. 17 Chinese state agencies were involved. 43 nations received confidential emissaries between January 29th and February 2nd. $960 billion in foreign exchange reserves were repositioned within 72-hour operating windows. Chinese intelligence had mapped every pressure point in the American financial system with the precision of an anatomical diagram. For 18 months, teams from the Ministry of State Security monitored U.S. Treasury bond purchasing patterns, petrodollar flows through the SWIFT system, and systemic vulnerabilities in energy derivatives markets. They knew exactly how many days it would take the Federal Reserve to detect a coordinated sale of U.S. Treasuries. They knew which European banks had excessive exposure to Chinese currency swaps. They knew which Persian Gulf oil producers were willing to accept digital yuan in bilateral transactions, as long as they received implicit guarantees of protection against American retaliation. Nothing was left to chance. The routine was familiar. Every Tuesday at 11 o'clock EST, the United States Treasury Department held auctions of short-term securities. Every Thursday at 8:30 a.m. EST, inflation data was released, moving trillions into speculative positions. China not only knew these patterns, it had built predictive models about how markets would react if certain assets were taken out of circulation at specific times. The integration between the People's Bank of China, the National Development and Reform Commission, and the State Foreign Exchange Administration was absolute. Each decision had been simulated in controlled environments. Each international counterpart had been probed, tested, and validated. When the final order was issued, no agency had to improvise. February 3rd, 2026, 9 o'clock GMT +8, the first action did not involve missiles, ships, or troops. It was a series of encrypted communications sent simultaneously to 31 central banks on 4 continents. The content was identical. Confirmation that China would activate yuan currency swap lines for any nation subject to US secondary sanctions related to trade with Iran. The message included preferential conversion rates, exemption from dollar counterparts, and immediate access to the SIPS system, the Chinese alternative to SWIFT. 12 hours later, Pakistan publicly announced that it would accept payment in yuan for textile exports. 4 hours after this, the UAE confirmed that it would allow bilateral transactions in Chinese digital currency for natural gas contracts. Russia, which has already operated partially outside the dollar since 2022, has expanded its direct barter agreements with Beijing to include crude oil and grains. At 2:20 p.m. EST on the same day, the first wave of impact hit Wall Street. Traders began to notice that the volume of purchases of U.S. Treasury bonds had fallen 22% compared to the average of the last 6 months. China had not announced anything. There was no official statement, but the numbers were indisputable. Beijing had reduced its acquisitions of American debt to almost zero. At 3:47 p.m. EST, the VIX volatility index jumped 9.4 points. Hedge funds began to liquidate dollar positions. The euro rose 1.8% in 90 minutes. Gold reached its highest value in 14 months. The second phase began in the digital domain. At 22 o'clock GMT plus 8, China activated a network of blockchain nodes distributed across 47 jurisdictions, officially launching the international version of the digital yuan, the ECNY Global. The infrastructure had already existed for 2 years, but had never been used on a commercial scale. Now, any company in any US-sanctioned nation could open an account in seconds, without the need for traditional bank intermediation, without exposure to the SWIFT system, and without direct tracking by the US Treasury. Simultaneously, Chinese state hackers, operating under the coordination of the People's Liberation Army Network Operations Office, began a massive distributed denial-of service campaign against Western financial media platforms. It wasn't supposed to cause permanent damage. It was to create noise, delay analysis, and ensure that the narrative surrounding the events took long enough to take hold in Asian markets before reaching American audiences. Bloomberg, Reuters, and the Financial Times reported intermittent outages over the course of 8 hours. No attribution has been confirmed. No data was stolen, but the message had been sent. China had the ability to temporarily blind the information systems that underpinned trust in Western markets. February 4, 2026, 6:15 EST. When American markets reopened, the reality was undeniable. 7 nations had announced bilateral direct trade agreements with China, all structured to bypass the dollar. The price of Brent crude rose 11% due to uncertainty over future payment streams. The yield on the 10-year Treasury note rose 34 basis points, the biggest daily jump since March 2020. The White House called an emergency meeting of the National Security Council. The Treasury Department issued a statement saying it was monitoring the situation closely. The Federal Reserve had no comment. Meanwhile, in Beijing, the Ministry of Foreign Affairs held a press conference at 10 o'clock GMT plus 8. The spokesperson read a 140-word statement. There was no mention of American tariffs. There was no direct criticism. Only one sentence stood out. The People's Republic of China will continue to promote financial multipolarity and uphold the sovereign right of all nations to choose their own trading partners. There was no epic confrontation. There was no fiery speech. The moment of greatest impact occurred in spreadsheets, Bloomberg, terminals, and silent boardrooms where analysts realized the world had changed while they slept. Over the next 96 hours, China signed additional agreements with Indonesia, Saudi Arabia, Argentina, and Nigeria. The volume of yuan transactions in global commodity trade increased by 34% in a single week. Persian Gulf sovereign wealth funds have begun to diversify their reserves, reducing exposure to the dollar in favor of multi-divisional baskets. The extraction was perfect. There was no retreat. There was no public negotiation. China did not offer concessions because it had not requested permission. Everything was presented as a sovereign choice, a legitimate exercise of economic policy, a proportional response to unilateral action. February 11, 2026. 7:34 p.m. EST. The United States Treasury Department released a confidential report to Congress admitting that the dollar's dominant position as a global reserve currency had been materially challenged for the first time since 1971. The document remained classified for 48 hours before being leaked to the press. Operation Red Dragon was completed with complete success. The primary objective to demonstrate that unilateral tariffs had a measurable strategic cost was achieved without firing a single shot, without mobilizing a single troop, without violating a single international law. The final state is irreversible. The system has been reorganized. The world simply woke up different.